A very good afternoon, good morning. Welcome to HYCM's live market analysis with myself, Giles Copland. Don't forget, as we look at different events, entries, exits, the whole idea is that this webinar is an educational webinar and it's not meant to be trading advice. Those of you who have been following here for months, weeks and years know exactly how this works. If this is new, please remember, don't be afraid to ask questions as we go through the webinar. What we're looking at today is some really important things I've got to share today. First of all, I'm just going to show us how to factor in the geopolitical risk alongside the other narrative of the Fed's sharp interest rate hikes. There's two main narratives going on at the moment. We need to know what both of them are. That will help us navigate the current risk complex. We also have, and I was speaking to a Reuters journalist this morning about this, I think we have some potentially real good upside that's preparing to set up in the Aussie Yen, the New Zealand dollar yen. Now, there are significant risks to this trade, and they are geopolitical because the yen sees strength when markets go risk off. So just going to make that clear what those risks are, but also explain what the opportunities potentially are. So, you know, it's well worth looking at that today. And I know I've been talking about the New Zealand dollar yen, Aussie yen for a while, but I do think this is coming to a climax. And there's a number of fundamental factors which we'll be looking at. On Wednesday, we'll be looking at the RBNZ interest rate meeting trade. In the run up to Wednesday, I'll be looking at the Australia wage price index. So we'll look at that today. Okay, folks, without further ado, I'm going to get stuck into the webinar because we've got an awful lot to cover today. And what I'd also like you to say is please do mention if you have any questions, if you have any things you want to say, please do use the question and answer box and the chat box. Very happy to answer questions. If I can, I'll ask them as we go along. Otherwise, I will cover questions at the end. So let's just find out where we are. Now, markets started the week tilting risk on. That was on the news that President Biden and President Putin, with a deal brokered by French President Macron, would be having a discussion, a summit meeting together on the condition that Russia did not invade Ukraine. Now, we are seeing geopolitical risk headlines at the moment. First of all, I would say is don't miss my blog, and on my blog I do show how to trade political risk headlines. Okay, so I'll put a couple of things in the chat box here. First of all, I'm going to put a resource with the financial source terminal that we have access to as HYCM clients, and if you haven't seen that before, take a look at that because it uses a new squawk, and a new squawk is very helpful because one thing that you need when you're trading geopolitical risk events. Okay, so I did a video over the weekend and I outlined how to trade geopolitical risk events. It's a nice video there. Do have a look. If you want to share it across social media, that's always appreciated because it gives me brownie points. Have a look there, and in it I go how to trade geopolitical events, and I go into it some detail. I'm going to briefly summarize some of that now, but do check that out later. Now, the go-to pair for trading risk events would be something like the Aussie Yen. Okay, so let me just show you the Aussie Yen. Let me just show you what's been happening. Right, now we'll drop down to the hour chart. Now remember when this Russian-Ukraine crisis really started breaking out? It was on that Friday 11th, just before heading into the weekend, and we saw the Aussie Yen pair dip like 100 points on the headline, right? And then we saw another headline here, dip, and this was another positive headline now. Now we are getting, what happens is markets get tired of geopolitical events. So do you notice how each time that was like, let's see, this headline, that was when US said Russia, they thought Russia was going to make it. That was like 128 points. And then the next like move lower was 100 points, and then the next move higher was, you know, I think you want to take out that initial low, you know, 50 points. So you see, you know, each time it's getting a little bit lower. Now that's common. because markets get tired of hearing the same events over and over again. So when you're trading geopolitical events, one, you need a professional news squawk. I've put a link for you how to get it and how you can get it as an HYCM client. Also, what you will need is a catalyst. Now, at the moment, each time that the news happens, the reaction is a little bit smaller. So now, this is not really tradable unless we get really significant news. And if we get so that was the fall earlier today on this headline. That was on the 8:30 headline that Russia's Kremlin says no concrete plans yet for a meeting have been agreed. Okay, and that's when you saw risk sentiment hits suddenly. But that is very hard to trade, you see, because that, first of all, is only from start to finish, right? It's only like a 25-point move. Now, you could have got filled in here at 82.77, right? And then you're underwater. Would you want to hold as price moves higher? So just going to show that the geopolitical risk event trade is not gone, because it could suddenly come back if there's a big headline. So the sort of headline you want now is that Putin and Biden agree to Russian-Ukraine truce, or US says that Russia is withdrawing troops, something like that. That's tradable, okay? And the go-to risk pair is the Aussie Yen pair, because that is generally seen as a proxy for risk, okay? Now, let me just show you. If we overlay here the S&P 500, right, just put it over the top, what you see is that, look, when risk is negative, the Aussie Yen falls. When risk is positive, S&P 500 rises, Aussie Yen rises. Falling S&P 500, falling Aussie Yen. Rising S&P 500, rising Aussie Yen. You see? Okay? So essentially, now that correlation is not always perfect, obviously, but it's a go-to risk pair. So if markets are feeling positive about risk, then you expect Aussie Yen to move higher. Okay, that's the proxy. That's the trade to be looking at. Now, with that all being said, we've covered geopolitical headlines. I've shown you a video how to trade those in a very effective way. I also want to show you something else now. What I want to show you is, again, this is from something on my blog, but it's important. Generally speaking, equity markets take significant geopolitical events in their stride. They don't tend to worry about them so much. Look at all these events over the years. Can you see? The 6-day war, only 1.5% drawdown in the S&P 500. The S&P recovered in 2 days. Look at this, the Suez crisis. Look at the Cuban Missile Crisis. Market fell just over 6% but recovered in 18 days. US terrorist attack. Yes, that was one of the worst incidences we've had in modern history in terms of significant geopolitical events. But even that saw a full market recovery in 31 days. And that did spark a whole sea change in the Middle East, not least the US moving into Iraq, Afghanistan, significant actions. And even when the Pearl Harbor attack occurred, which brought the US into the Second World War, even then saw a full market recovery in less than a year. So the average falls in the S&P 500 on geopolitical events are relatively mild, okay? So mark that. So that, in that context, that's partly why you see that, yes, we are seeing some downside in equity markets, but they're relatively contained because the market knows that those dynamics are in play. At the same time, what is weighing on equity markets? It's the fact that the Federal Reserve is hiking interest rates on a quick cycle to contain surging inflation. And the markets are concerned that the Fed is going to be hiking too fast, too soon. Now, another learning point. When the S&P 500 falls about this level here, 23, 25%, if you got falls of that level, most times that signals a recession. I think it's something like the last 8 out of the 9 times, or the last 7 or 8 times the S&P 500 has dropped, 20, 22, 23%, something like that, it signaled a recession. You can have a look on my Twitter feed. So like that tells us something. One, the Fed's not going to worry with the S&P 500 only falling 12%. That's not panic button. This is panic button. This is the level where the Fed might change their policy outlook. Also, that's the area to buy dips in the medium term. So someone put a gun to my head, and what do you think stock's going to do? The stock's going to have a couple of legs lower, and then maybe have some really good gains in the fourth quarter of this year. Now, that's just my opinion, right? And I will be updating that depending on what happens. But what you're looking for here is you're looking for growth and inflation. So if growth keeps going, then equity markets can keep moving higher. Don't forget that it's not that equity markets can't move higher when the Fed's hiking interest rates. That can happen, okay? What it is the fact that the Fed is expected to hike too quickly. That's the issue. So if you get your head around that big picture, then that helps you deal with some of these recent, and that's the area where you can expect the Fed roughly to turn around. Now, obviously, I'm not making a prediction, but I'm showing you that's the guideline for where we can look for medium-term gains. Now, they're the twin drivers. With that being said, now let's look at the best opportunities we have coming up this week. So the best opportunities that I can see on Wednesday, we've got wage price index data from the RBA and RBNZ interest rate statement. Now, let me explain to you what's going on here with the RBA. So if you just take a look at the Reserve Bank of Australia, let's have a look. Where's there? Okay, let's just look at this RBA. Let's look at their we'll look at their last monetary policy report, and I'll show you what's going on here. Right. Monetary policy. Just go to their website. Look at the last monetary policy report, monetary policy decisions. 2021, 2022, we've had the first meeting, right, fair, there we go, right. Now, what they've said, and this is how you use interest rate statements, you look at what the bank's focused on. And what they're saying, they're focused on wages growth also remain modest, and it's likely to be some time yet before aggregate wages growth is at a rate consistent with inflation being sustainably at target. So what the RBA said is that, yes, we are, full employment's good, everything's heading good, but we won't increase the interest rates until actual inflation is sustainably within the 2 to 3% target range. And they're saying it's too early to conclude that it is sustainably within the target band. There's uncertainty about how persistent the pickup in inflation will be as supply side problems are resolved, and wages growth also remain modest. So in other words, what the RBA are telling us is that it's wages growth that it's key focus. Right, what's coming up? Wage price index. How important will that be? Very. So this is where we're at with their wage price index. Let's just have a look. Right, this is what they're expecting. So the last reading was 2.2%. They're expected to come at 2.4%. Now you can see here that since 2008 global financial crisis, wages have just been pushing lower and lower and lower. Like they have around the world, we've seen deflationary pressures. Is it automation? Is it a globalization? But there seems to be some pretty serious pressures that are deflationary on the global economy. Now we're seeing inflation surge. Most analysts think that's due to supply side constraints and that inflation is going to be temporary. Now, temporary could end up being 3, 4, 5 years. So a lot of central banks have dropped that temporary language because they don't seem like they don't want to be making like policy mistakes in the near term. But fundamentally, you can see the pressures to the downside. Now, of course, that could change. I'm not a prophet. I can't see the future. But what we do know is if this comes in above 2.4, so it comes in at 2.5, that will really boost the case for Australian dollar longs. Now, if you drew a trend line across the top here, you see that this is breaking high. Now, that is significant because it tells you that that's a probable trend change, right? Once you get that downtrend break, it's a probable trend change. So if we go above 2.5, then that means we're heading above 214 highs. Now, if we manage up 2.7, that would be 2013 highs, and that would mean, remember, what the RBA have said, it would mean that all of a sudden the wage growth is significantly moved to the upside, right? So that would give the RBA reasons to hike interest rates. Now, what's been going on is that the market has been seeing the way the RBA has been acting, and we've been seeing the Australian dollar gain last week, even though there was risk-off trading, right? Because markets begin to think, well, hang on, the RBA is behind the curve. And we had RBA's Governor Lowe saying that it might be appropriate to raise interest rates this year. He did that February the 10th, February the 11th. So after, on February the 1st, we had the rate statement, we've had Governor Lowe make a move towards the market's pricing. Now, the market's pricing is incredibly aggressive. It is too aggressive, for sure. And if you look at, using this resource here from Financial Source, which HYCM clients can get access to, you can see the expectations for interest rate hikes here. Look, 6 times the RBA is expected to hike interest rates according to the implied rate probabilities, right? Now, is that too high? Yes, of course it is. But, with the RBA saying they're going to be patient and not hike at all, there's a mismatch between market expectations, right, and what's going on here with the implied rate probabilities.
Meanwhile, Brent at 94.
Just an example of how the audio score works. You see, you just have it on, and when something breaking comes out, you get a headline. Okay, so very helpful to be having and using the audio score at this point in time, notwithstanding the fact that geopolitical risk is fading. But I just want to show you an example of how that works with the audio score in the background. Now, the Australian non-commercial futures positioning shows that, look, these are stretched shorts. We've got the most shorts in the Australian dollar since at least 2007. So it looks like speculators have been too short for too long. Now, why were people short the Australian dollar? Remember, China's growth was slowing. We had Australia struggling with Delta variant, etc., etc. Now we have China, People's Bank of China, cutting interest rates. Okay, the rest of the world's hiking interest rates. People's Bank of China is cutting them. We've got fiscal stimulus expected from China. That should all boost the Australian dollar. We've now got the RBA making a more positive aspects. So that means Australian dollar longs could be very interesting. We've got the employment data out of Australia. The last reading was a beat, 12.9K. Now, admittedly, most of those were part-time jobs, and the participation rate was higher, which was good, but still, it's a beat, and expectations for more Australian dollar upside make sense. There's one caveat here, which is Australia's opened its borders again. So you can see that when arrivals plummeted to Australia, when the borders closed, the borders have opened again. So that means there's more foreigners around, so that those who are employed, you notice how the employment level shot higher as the people entering lowered. So what some investors are saying, well, then wages might keep a cap on wages, but we'll see how that goes. So all of that means that the Aussie CAD pair does potentially look attractive for dip buying if we do see a beat in the data. Now, one area to look at is if we manage to close above this 0.9160 region, and then if we see a beat in the wage price index above 2.5%, then we expect buying in the Aussie CAD. Now, the one problem with this is if there's geopolitical risk, then we'd expect oil to strengthen, and that could result in significant Aussie CAD downside. So look out for that. The other option will be looking at Aussie New Zealand dollar, but the problem with this is you've got wage price index data coming out, you've got the RBNZ interest rate decision coming out, so you don't want to be trading both of these at the same time. But this is worth looking at. If we saw wage price index really good and the RBNZ is more dovish, then you'd expect upside in the Aussie New Zealand dollar, and you could go with a break of that trend line to the upside. Aussie Yen would obviously be a potentially great trade. If we saw a wage price index surge, we expect Aussie Yen upside over the medium term. But the problem here is that when the markets are spooked, we see the Japanese yen bar are bid. Now, I would say any retracement lower on risk-off trading back down to that 80-20 would be perfect for longs. So you could have a buy on limit order at 80.30 with stops just below 78.50. Okay, so if price did spike down there on a Russian-Ukraine fear, okay, that's a decent support level. So you'd expect to find buyers in this area. And if you want to be more cautious, you could have your stop the other side of 77, 76. Now, there's obviously risks with that, that the yen does see bids, but over time, we expect an Aussie yen pair to keep moving higher, okay? Particularly with the outlook looking so good. Now, this is what you have to get from the yen, okay? This is why the yen is so looking structurally like it could be so weak. Let me show you what's going on. It's all to do with the Bank of Japan. Now, do you see how the bond yields are surging higher across the board? 10-year yields in the US, German bonds above in positive territory for the first time in ages. Canada nearly 2%, New Zealand bonds, 2.76%, Aussie bonds over 2%, UK gilts, nearly 1.5%. Oh, Japanese bonds 0.212%. Right, Japanese inflation is very low still. So there's nothing to worry the Bank of Japan in terms of inflation right now. Secondly, the Bank of Japan has said they're going to keep this bond range within the plus 0.25 and minus 0.25 region. And it's been in this region, in this realm for like 12, sorry, not 12, for like 6-7 years. And the BOJ said we're going to keep it that way because we're going to buy an unlimited amount of bonds to keep the yields low. So that means structurally there is reasons for the yen to remain weaker compared to like the Aussie yen and the New Zealand dollar yen. So that means upside in Aussie yen and New Zealand dollar yen do make sense over the medium term. Now I've been talking about this for a while, and I am personally long the New Zealand dollar yen from this region, right? This makes sense. Any retracement to lower makes sense to buy on dips, and stops can be placed quite tightly just underneath that 74.50 region. Similarly with the Aussie yen, if we do see a wage price index hike, we expect this to surge higher, look for a break of that trend line. But remember, the risk with these two trades is that if we see yen strength on a Russian-Ukraine escalation, so that dip ultimately medium term you expect to be bought, but remember, you always have to manage your risk. So where's a good place to manage risk? At this point in time, it will be underneath that 74.50 region. But if it does, your stops do get hit, it's far better to wait and have a real opportunity to enter. Target your that 81, 82 region in the New Zealand dollar yen. Now, what could change that outlook is obviously RBNZ meeting on Wednesday. We will cover that in more depth and detail as we get closer to the event. So that's what to look for the wage price index for Wednesday. The manufacturing and services PMI, again, worth looking at for the US dollar. Not necessarily going to majorly change the dial. Remember, the US expected to hike rates aggressively this year. So any slowdown in manufacturing and services is likely to see that really weigh on the dollar. If we start to see some bad economic data coming out from the US, expect that to weaken the dollar as markets expect the Fed to be making a policy mistake, raising interest rates too high, too fast. The oil inventories saw an interesting build for the first time in quite a long time last week. So that will be interesting. But remember, what's going on with oil is complex. We have the fact that the Russian-Ukraine crisis has been artificially boosting oil prices. So if that keeps moving higher, oil prices keep moving higher on the Russian-Ukraine crisis, then oil inventories will take a lot less significance. We also have the US-Iran nuclear deal. If that is revived, that's a negative pressure for oil. But if the Russia-Ukraine crisis escalates, that's positive pressure for oil. Personally, I'm staying away from oil now because the drivers are so mixed. This will be key event, PCE price index. Now, inflation is top importance right now for central banks around the world. This is no exception. If this data comes in a big miss, that could be a great opportunity for going long in gold. Gold has had a really good run. And if you remember, what I'm looking for gold is I really want to see two things come together for gold. I want to see real yields fall and the dollar fall at the same time. So if there's a miss in core PCE data, that could be the catalyst that you need to see both the real yields and the dollar move low at the same time. Do you notice, if we just, do you see here, when like real yields and the dollar fall together, so real yields is the orange line, dollar is green. When they both fall together, that boosts gold. Okay, you can see real yields falling alongside the dollar. You know, even with the dollar sideways, but real yields falling, that boosts gold. When you've got here, you know, you've got real yields falling, the dollar falling together, boost gold. Real yields falling, the dollar boost gold. Now, recently, what we've had is we've had like real yields surging higher and the dollar pushing lower. Now, what we're looking for is if there's a miss of this data on the PCE index, say that comes in a month on month, let's have a look. Say that comes in like 0.5% expected. So say it comes in like 0.2, right, or 0.3. You'd expect yields to move sharply lower, and that should weaken the US dollar, and that should also bring real yields lower. Let me just show you here. Right, so if that's a miss, you'd expect yields to drop lower, and if yields are dropping lower and the dollar's dropping lower, that should boost gold. Now, gold, in terms of where it's at that key 1900 resistance level. So major support remains at that 1850, 1860 level. But say you got like a reading that was very weak, you see real yields fall, you see the dollar fall, look for gold to break out and look for a breakout retest of 1900 as a retest back up to that 19 sort of 45, 50 region. That would be the obvious entry. If prices in gold moves lower into the event, the closer we get to this level, the better, because that would be a very nice area to lean against if we got a very weak PCE reading. So I think the best opportunity for this event would come from gold. The other option is, say this was a big miss and the RBNZ turned more hawkish, you'd expect New Zealand US dollar upside. Say this was a big miss and the wage price index was a good reading for the Australian dollar, you'd expect Aussie US dollar upside. So they are the reasonable explanations, and they're the best trading opportunities that we had this week. And what you're having to keep into your mind is these two narratives: one, geopolitical risk events with the Russian-Ukraine crisis, and trading those geopolitical headlines. You know, and there's constantly these kind of news, you know, counter reports, contradictions, confirmations. Remember, in a war, and obviously we're not in a war, but we're in a war-like environment between Russia and Ukraine. You have information and misinformation, and that itself is a war tool. It's a propaganda tool. Now, the reason I say that is that in terms of trading, be very careful, because headlines can be contradicted as quickly as they are released. Okay, folks, they're the key events today. Wage price index, RBNZ interest meeting. We will be back here on Wednesday for our workshop, and that will be where we will be looking at the RBNZ rate meeting. At the moment, investors are partly expecting potentially a 50 base. Some analysts are expecting a 50 basis point interest rate hike for the RBNZ on Wednesday, and that does really make sense when you consider the fact that we haven't, you know, heard from the RBNZ for quite some time. But let me just show you something, and this this struck me. this is the New Zealand dollar. And you see how this year the New Zealand dollar has been very weak, right? Now, this is the most hawkish central bank, and look how weak it's been. So seeing some of these, seeing this strength come in last week made sense, because investors are expecting maybe the RBNZ is going to turn more hawkish. So it's not a surprise to starting to see some New Zealand dollar bulls coming into play. And if this kind of, if we start to see a hawkish tilt, you'd expect the New Zealand dollar to really move higher. And if we just look at this on the daily chart, you can see that we have had a potential trend change here. With that is like a potential trend reversal. Now we'll need the RBNZ rate decision to keep pushing this higher, but that looks like the New Zealand dollar is beginning to change tact. So that's why I was buying the New Zealand dollar into the RBNZ rate meeting. Euro New Zealand dollar shorts, New Zealand dollar CAD longs made sense, as well as like I took an Aussie New Zealand dollar short, which wasn't the best trade because of the wage price index. But I'll be pulling that trade before movement stops to break even, because you don't want to be trading the Aussie New Zealand dollar with two big risk events happening simultaneously. Folks, it's been a pleasure as always. I hope you have a very good rest of the session. It's been a really enjoyable session. Oh yeah, Suman, what do you think about pound Australian dollar sell? Always happy to look at individual currency pairs. Now, the outlook for the difficulty here is the outlook for the Australian dollar looks strong. Now, so that would favor Australian dollar upside, which would favor pound Aussie downside. The problem is that the pound, yes, you could argue that there's quite a lot of hawkish expectations for the pound, so you could argue there would be a little bit of downside. But the thing I don't like about this is that you're right in that key sort of support level. So I think I'd only consider this if I started to see support break. Now, as things stand, this is a key support level about that 1.8850. So the risk reward doesn't make a lot of sense, okay? Because you've got this region here, and you've got the wage data coming out on Wednesday. So there's definitely a risk with what happens there, because if that wage is a big miss, then you would see a case for more pound Australian dollar upside. Now, on the positive side, there's a nice head and shoulders pattern here. You see you've got a left shoulder, right shoulder, head. So what I want to see for a pound Australian dollar short is I want to see a beat in the wage price index, and then I'd want to trade a break of that neckline, and then you're ultimately looking for a move back down to 1.8600. Off the top of my head, if I was going the Australian dollar route, I would prefer an Aussie CAD upside. So that would be my preferred expression of Australian dollar strength, because oil looks really high and it should be due a correction, but the risk is obviously that geopolitical risk. So the benefit, Suman, on the pound is that you haven't got that geopolitical risk with the Russian-Ukraine invasion. Hope some of that helps. Yeah, thoughts on if Thursday's PCE will confirm a 25 basis point versus 50 basis points in March. Yeah, you'd expect, if there's a miss in the inflation data and it leads markets to a 25 basis point high, Stefan, great point, you expect yields to drop lower sharply, okay? So you expect that to move higher, and you expect the dollar to move lower sharply. So what you do, you'd expect dollar weakness, and you'd expect upside in Aussie US dollar, New Zealand US dollar. The pair to trade, now both of that depends on the RBNZ and the wage price index. The pair that I would obviously trade would be the Euro US dollar. So if you saw a miss in the PCE data, then you expect Euro US dollar upside, okay, for sure. So that would be the pair I'd be looking at. In terms of gold, again, upside in gold, upside in silver, both of those make sense. In terms of equities, you would expect to see a little bit of an upside because the Fed won't have to be so aggressive, and so markets will be relieved that you're not needing to see interest rate hiking too fast too soon. So I expect weakness in the dollar, upside in stocks, upside in gold, upside in silver. Does that make sense, Stefan? That will be my expectations. Okay. Okay, folks, the pleasure as always. Thank you all very much. And don't forget, come back here on Wednesday and we will be looking at the RBNZ rate decision. Take care, everyone, now. Have a very good week. Goodbye.